Yes, it is the answer to this question. Is New Zealand commercial real estate the most reliable income option for investors? We believe so. To further reiterate some of the points that Tony was making, this line from the back, you can't see it at all, so I'll explain it. The title to this graph is Annualised Inflation-Adjusted Net Cash Returns on different investment asset classes over time. The ones down the bottom, you could probably see are returning under zero, well under zero, between sort of -1 to -1.5%. What I like to use this graph, and many of you will have seen it before, because it visualises, helps us visualise what Tony was saying. So those three bottom lines down the bottom are essentially fixed interest products in New Zealand on terms rating or ranging between 6 months to 10 years. And that is corporate sovereign bonds and cash in the bank. All right, so Kiwis are losing north of $1 billion every year right now through cash, accumulated cash that they're keeping in the banks. The banks love Kiwis with money in the banks right now, right? It's easy, it's free, essentially. But Kiwis are far better, worse off as a result of this. And I think, though, sorry, I'll come to the top line soon, now. So the top blue line is PMG funds consolidated returns, and the yellow line is the listed property sector. So there is a bit of divergence between listed and unlisted there, or a yield premium for being in the unlisted space, like with PMG. But I do think Kiwis are starting to wake up to the fact that cash in the bank, and you're all testament to that, cash in the bank is not working for us as investors anymore. And the way in which we can see that happening is if you look at cash held in banks right now, it's increasing. But the proportion of cash in the banks held on deposit versus cash is decreasing. So Kiwi deposit holders are saying, that's it. We have had enough. We are now, I suppose, seeking opportunities or other alternatives to generate a better return on our money so that we can lead the lifestyle that we believe we're entitled to lead, and I think that's fair. So we are seeing an increased movement out of fixed interest products, and that's why you're all in the room. And commercial real estate, is it a reliable option? Yes. Now, valuation-wise, it does bounce around. Through the global financial crisis, commercial real estate in New Zealand lost circa 30% of its value, and it fully recovered within 3 years. The share market comparatively took about 7 years to fully recover its losses. So Kiwis flock back to reliable income streams and bricks and mortar when things become uncertain. And we saw that behaviour in the GFC, and at some stage in the future, when we do hit I'll refer to as a proper recession, we will see that again in the future. But the green and the red line demonstrates that valuation change over time. But the green line illustrates income. And you can see that that is incredibly consistent all the way through. And the higher the quality of your real estate, the better the quality of your tenants, the more consistent that income should be over time. And this is what's helping drive unprecedented interest in not just PMG funds, let's be fair, but some of our competitors' products as well. And this alternative let's call it a fixed interest proxy type product, continues to see quite honestly, just unreal sort of demand to invest in this space. So I'm going to talk a bit about the PMG generation offer. That sets the scene around what we've been seeing and what we expect to continue to see. Generation fund, much like PMG's other funds, is designed to be diversified by geography, by property type, and by tenant industry. And thus mean that as investors, we don't have all of our eggs in one basket. So if the volcanoes in Auckland start deciding to blow up, that might have an impact on some of the real estate, but not all of it. If Christchurch decides to get shaky again, same rules apply. And the case that I sort of refer to around when that became important was when Auckland last year went back into level 3 lockdown and the rest of the country remained at level 2. Now, a lot of our listed peers have been consolidating in the Auckland commercial real estate market over the last sort of 5 to 10 years. And what happened was they had to have that discussion around what rent relief might look like for those tenants in Auckland. And because we had a portion of our portfolio there, now relief may or may not have been provided, but there was the conversation. And so by having a nationally geography diversified portfolio, we can help mitigate some of that risk. It's designed to provide sustainable cash returns. Again, the diversification in the portfolio helps drive that. We don't have any reliance on one tenant to generate our returns, so if something happened to a tenant, it shouldn't have a material impact on our performance. Real estate over time does tend to deliver growth and value, as I'm sure many of us are homeowners or property owners, we know this. Land, bricks and mortar does go up. And we address the idea of improved investor liquidity by breaking down barriers to access this type of investment product. So if you wind the clock back 30 years, minimum investments in this space used to be $250,000, $500,000. So your amount of clients that could gain access to that in New Zealand might have been this big. With the Generation Fund, we break that right down to a minimum investment of 1,000 units at $1.09, so $1,090. So your availability of investors who can access this is exponentially larger. Now that doesn't disadvantage anyone in the room, but what it does do by having that lower minimum is open up the under 30s, the under 40s, the under 20s that can gain access now to a very critical asset class, which we know creates long-term wealth, and they can get in there now. And what that means is we've got more investors who are comfortable, familiar with the product and our company. And at some point in the future where some investors might decide to liquidate or sell your investments, we've got a much larger, more active buyers pool there that can facilitate that trade. So as it stands at the moment, the property portfolio consists of 3 assets, 26 Sharp Road in Hamilton. This is leased to Torpedo 7. This is their national warehouse and distribution centre, and they feed product, comes in off the ships, and then they feed that out to their retail stores, and this services their online business as well. 67 Vicaries Road, this is in Christchurch. Wigram is a very tightly held industrial precinct in Christchurch, inland sort of back towards the airport, I suppose, or halfway between the city and the airport. Leased to a company called Euro Corp, and they have a number of brands under their umbrella business. Out of here, they run a company called Complete Reinforcing, Summit Steel and Complete Reinforcing. And they do fencing, steel products, and construction and infrastructure steel product manufacturing. And Jamaica Drive, Granada North, for those of you that know Wellington, Granada North is a wee way out of the CBD. It's probably about 15, 20 minutes north, more or less over the road from Tawa as you head towards Porirua. Granada North is a very small industrial pocket. Myself and my team were there early last week, well before this stuff happened, with regards to this Aussie traveller, so don't worry about us, we're fit and healthy. But the anchor tenant here is Coca-Cola. Amatil, this is their Lower North Island distribution centre, and the 2 other tenants on the site are Micrographics and Rent-A-Kill. And the total metrics as it stands at the moment, just a touch under 60 million, it is completely full. Loan to value ratio at a conservative level of 37%, 3 assets, 5 tenants, and a weighted average lease term of 3.5 years. More importantly, we want to discuss what the fund will look like post the acquisition of the 2 target properties. So we've got 19 Bethlehem Road, otherwise as we know it all as locals, Bethlehem Town Centre, and Gough Street, Seaview, Lower Hutt, Wellington, an industrial site in Seaview. Just to give you some context, the Wellington industrial market continues to remain buoyant. Wellington's economy continues to remain buoyant. Wellington has significant land constraints. For those of us, I'm sure we've all been there, it's surrounded by hills, a lot of reclaimed land in the CBD. There is not a lot of room to carve out more land, and access to major arterial routes, state highways and the port, other infrastructure, key node areas, is critical for industrial-based tenants. So the area of Seaview is a very tightly held industrial precinct. Overall, Wellington industrial vacancy is around 1.5%, and that's the lowest since records began. Seaview, about 0.2%. So you could almost argue that it's virtually non-existent. So from a landlord's perspective, we already own, via the Pacific Property Fund, which many of you will be familiar with, industrial property in Seaview. So we're very familiar and comfortable with owning real estate in that area. Industrial rents have increased about 3% over the last 6 to 12 months, and that's simply due to increasing demand from industrial type tenants for space and not enough supply coming to the market. So when that happens, we get rental rates or pressure on rent rates in upwards direction, which is great from a landlord's perspective. The greater area will benefit from big infrastructure developments like your transmission gully, and all your major real estate agencies are predicting further growth with respects to rental growth and yield compression. And so this sort of summarises why, as a commercial property investor, we're very interested in this space, continue to be. So the Gough Street asset, prominent location in Seaview. We're probably 5 minutes or less from your state highways going south or north, and probably about 10, 15 minutes from the port. As I said, market vacancy in this area is incredibly low. There's a 10-year lease from December 2019, so that takes us out to 2029, with a company called HJ Asmus. They're over 100 years old, still family owned, and they're a leading supplier of steel products throughout New Zealand, and worked on a number of large infrastructure projects nationally. Seismic rating at 67% here of national building standards. Now, for an asset like a multi-levelled office property, we might be concerned a bit more about that. For a single-level industrial property, we're less concerned. They don't have significant, if any at all, racking internally, so not storing products vertically, where if they had a good shake, things are going to come crashing down on workers. Things are stored more or less at ground level, and they don't have a significant number of staff operating within there. So for a single level industrial site of that nature, with the way they interact with that real estate, we're quite comfortable with that. Tauranga retail market, very strong population growth. We're targeting 18% over the next, or on track for 18% over the next decade. We've experienced as a region or a city 9% annual economic growth over the last 5 years. Retail trade volumes expected to grow to somewhere in the vicinity of $1.5 billion between now and 2023, so let's say 10 odd years. And Tauranga, when compared to the national averages, is quite under-retailed. So Tauranga, at national average, is about 0.50 square metres per person nationally. Now Tauranga is at 0.39 square metres. So what that metric essentially shows you is there is not enough retail commercial real estate compared to national averages here in Tauranga. And that's sort of signifies opportunity as far as an investment thesis goes. So over 100,000 people live in Tauranga now, predicted to grow to 115,000 in the next sort of decade, and there is limited new supply set to hit the market, particularly in that large format space, which is what we're attracted to here in Bethlehem. What else are we going to talk about? That's probably it on that slide. Let's get into specifics about Bethlehem Town Centre. So the purchase price or acquisition price is just a touch under $95 million. This is a true institutional grade asset, and PMG's largest single acquisition we've made in almost 30 years. It's 7.8 hectares, so this is a large land holding in what most of us locals would describe as a key location. High profile, good access, incredibly well car parked with over 1,000 car parks on the site. It's been developed quite thoughtfully and carefully over time, with something called a sight line and things in mind. So when you come out of Countdown or Kmart, you should be able to see the brand on the other side of the centre, and it helps people come out and go, oh, I need something for dinner. And so they walk out of Kmart and they immediately see Countdown, and they walk through all the other shops on the way through. And now you're all sitting in your seat going, I've done that before. And that's the intention. That's why it's been designed that way. That helps to facilitate spend and economic activity on the site. So very thoughtful design. There are 54 tenants on the site, and over 55% of the total rent roll is driven from what we call the large format or bulk retail tenants, those being Countdown, Kmart, Chemist Warehouse, which is a major drawcard for that site. I'm sure pharmacy owners and things, there might be a couple in the room, don't despise that brand, but from a consumer perspective, it's great. BP, obviously recently developed, and Smith City. So there's 97% occupancy on the site, so there is a little bit of vacancy here, and that's attractive for us as an active value-add commercial real estate manager, because we can obviously lease that space up and generate more revenue from the site. Seismically, 100% of MBS and a weighted average lease term of 4.1 years. Interestingly, and we'll just be open about it, the Countdown lease has a couple of years left to run. They were in discussions with the current owners or vendors of the site to extend for a double-digit term already prior to us going in. So we know that there's no other real land available for them to develop anywhere else. If they wanted to do that, they're running out of time, essentially to have something completed by the time their lease is up. And we know that their site is under rented to the tune of almost $300,000 per year. So one of the first jobs we'll have as an owner of the site is to go to work on that deal. And we're very confident, having done this time and time again. We do an assessment of what's in and around the site, what the flight risk looks like, and make a call on that. And we did the same with Coca-Cola in Jamaica Drive, where we added about $250,000 worth of rent and extended the lease, and that had massive upside on the valuation of that particular site. And we expect to do the same here. So on the completion and successful acquisition will be 5 assets, over 60 different tenants. We'll maintain the portfolio investment entity structure, $166 million portfolio value. So this then becomes sort of number 2 behind Pacific Property as our second largest diversified commercial property fund. We're lifting the weighted average lease term through this acquisition, and we maintain that conservative loan to value ratio. To give you an idea, some of our peers would be running at 50% as a result of under their loan to value ratio. Now that mightn't have been an issue about 12 or 24 months ago when rates were going down, but the more debt you hold over the next wee period as we start to see inflation, interest rates potentially coming up, that will be more of an issue. So we like to maintain that more conservative approach around debt. All we're trying to really demonstrate here with the wagon wheels, as I call them, is that prior to the acquisition, Torpedo 7 was responsible for 44% of total rent roll for this portfolio. Now, there is a long lease term still in place with Torpedo 7, and so it's mitigated to a point. However, we don't want to be reliant on that much rent coming from one tenant. So upon completion of this acquisition, Torpedo 7 drops significantly to 14%, and we add other large format retailers like Countdown, Kmart, etc. into the mix. So we have a much more diversified, more sustainable model post-acquisition than what we do pre. And all we're demonstrating here is that through your acquisitions, all you really want to see is your lease expiry profile pushes out to the right side of the graph through every acquisition that you make. And that's essentially a reflection of your weighted average lease term. So through acquisition, your leases are falling further out down the chart, and that's why your weighted average lease term is pushing out. So the offer is now open. We have 63 million units at a minimum 69 million total, so about 75 million of capital. $9 per unit price, 1,000 unit minimums, and then multiples of 1,000 thereafter. The offer is partially underwritten. It's open. It closes on the 29th of July. The cash distribution is lifting slightly from 5.8 cents per unit to 6 cents per unit. So original investors that paid $1 for their units about 12 months ago, in the peak of COVID-19, when everyone was going into lockdown and investor confidence was falling off a cliff, well done to you guys that took a position, because now your units are paying you 6% on original price, and you've had a 9% increase in unit value. So well done, and thank you for having the confidence in us to continue to deliver throughout that very uncertain period. But now you are paying $1.09 for your units, and it will show a 5.5% gross cash distribution. That's net of fees and expenses, gross only of tax, under the PI tax regime. And just one final note, to live our sort of dream of ensuring that commercial real estate remains accessible for as many different types of investors as possible, we've also had this available via the Sharesies platform, and we've had about 1,600 different investors participate through that. We only have to deal with one investor, which is Sharesies, which is, thank God for that, because my team couldn't handle 1,600 investors with about $100 each. And we're also making this available this week through the Invest Now platform, which maybe less of you will be familiar with, but they break barriers down to the managed funds sector. So normally managed funds are 20, 25 grand. They break it down right to sort of $100, $500 odd. So it's really trying to make sure that even more generations of Kiwis can gain access to what is a critical asset class for long-term wealth creation.